Hi, good morning, clients. Welcome to our special Tuesday webinar. My name is Te Hong, and I cover REITs. So today we have quite a few things on the agenda. Firstly, I'll touch on the REIT sector report. Following that, Sam will do a talk on Japanese macroeconomy. After that, Kenneth will do some technical updates, and then finally we'll have the week ahead. So let's move on to the REIT sector. A review on what happened, and I'll give you an outlook and the strategy as well. So for the REIT sector, we remain overweight on S-REITs, even though we acknowledge that valuations are catching up. As continuing the trend from last year, the REIT sector for the first 5 months of this year has outperformed the STI. And we think that this sector outperformance versus the STI is going to slow. So we think that clients should stick to REITs operating within resilient industries or geographical regions. We also think that the fundamental drivers for our top picks remain intact, and our overweight stand on REITs are actually built on a few factors. Firstly, the flood of liquidity still remaining in the system, yield-hungry funds looking for yields in the entire investment world. And if you compare REITs across the region, we think that the spreads for S-REIT actually still offer better value versus our US and Japanese peers. Even though the impending rise in the 10-year bond yields are going to lead to compressing spreads, but we think that S-REITs still offer better spreads versus our peers. Even though Hong Kong REITs have caught up with us in terms of spreads and valuations, but we think that S-REITs actually offer better exposure to more diversified sectors and geographical regions versus Hong Kong REITs. Nonetheless, we acknowledge that headwinds remain across the sectors, such as looming huge supply of commercial space, lackluster general retail sales, and the slow rebound in tourist arrivals. So, a look at the year-to-date performance of REITs. So, as advocated in our initiation in FCT earlier this year, we were saying that we were actually not very bullish on the commercial REITs for this year. And as you can see, there's quite a bit of red ink in the commercial sector this year-to-date performance. We are still selectively bullish on retail REITs, but we are advocating going in on REITs that can capitalize on the rising spending power of consumers within regions like China and Japan. Healthcare REIT as well. We are bullish on First REIT. Next up, we go to the key takeaways for the first quarter calendar year 15 results. For commercial REITs, the office rental index is still going up, and this is underpinning the commercial REITs rental reversions. But we see that growth is slowing. Grade A office rents grew 1.8% quarter on quarter versus the 5.1% growth we see quarter on quarter in first Q14. And we see that this growth rate is actually slowing from the last quarter of 13 and the first quarter of 14. And given that the huge supply of office space coming up in 2016, we think that this growth is going to slow even further. As for industrial space, our key takeaway from the results is that there is certain risks involved in sale and leaseback transactions which are happening in the industrial space. So typically vendors, they sell their properties to REITs and then they agree to lease back these properties. But we found out from management that a lot of these vendors, they actually tend to have the intention of not renewing the lease upon expiry. And in many cases, these vendors actually have the intention of using the proceeds from the sales to develop their own property and subsequently move into it. So this kind of intention actually create a tenancy risk for REITs when the leaseback period expires. For retail REITs, we see that general local retail sales remain sluggish. Excluding motor vehicles, retail sales for March actually fell 3.2% year-on-year. But we see that the strong mall operators were still able to grow shopper traffic quarter-on-quarter. Malls in certain suburban areas where the recent supply is huge, they are starting to get hit, and they are actually seeing slower rental reversions. And these areas include the Jurong East area, where we saw a lot of supply in the last few years, as well as the Raffles City and Marina Square areas. For hospitality, we think that the weak tourist numbers are going to stay, and corporate demand also weighed on earnings. Absence of biennial events such as the Singapore Air Show in February and weak tourism numbers affected earnings numbers for hotels. Weaker demand from corporate clients for service apartments also weighed on earnings. So next we drew down to the individual sectors. For the commercial space, if you can look at this chart and you see that the 5-year average, or rather the 10-year average, the average annual net demand for the past 10 years is actually 1 million square feet. But if you can observe this blue bar over here, in 2016, there's going to be one of 3.6 million square feet of space going to be flooded into the market. So if you look on a 5-year basis, right, from 2015 to 2019, the average supply annually is actually 1 million square feet, which coincides with the average annual net demand for the past 5 years. So, but you can call it bad timing or you can call it misplanning. This sudden flood of office space in 2016 is going to prove too hard for the market to absorb. So given that fact, we think that office rental growth could be subdued until 2018 as the market works off the excess supply. And add all this to the fact that if you observe the orange bars over here, the orange bars represent the net demand for office space. And if you can see from 2011, in fact, the net demand is actually dropping. The traditional office space demand drivers, the financial institutions, they're not expanding as fast as anticipated or wished. And instead, a lot of demand in recent years is coming from the tech sector. But how fast can Google, how fast can LinkedIn, or how fast can Facebook, or how much more can they actually grow? So with this weak demand and the huge supply in 2016, we think that this is going to put a lot of bargaining power in the tenants' court. So next, we move on to healthcare sector. Healthcare, essentially, we're just looking at 3 REITs: Parkway Life REIT, First REIT, and Religare Health Trust. So P-Life REIT, they actually have 2 revenue driver models for their Singapore property. We touched on that in our non-rated note. So one of the model is actually the CPI model, in which they will use the Singapore CPI for the previous year and plus 1%. The other model is actually a percentage of revenue model. So for P-Life, for the Singapore properties, since IPO, except for the first year after IPO, where they use the percentage of revenue, after that, all the years has been driven by CPI numbers. But if you look at Singapore CPI numbers for the start of this year, you see that CPI numbers are actually very weak. So for the CPI model to continue to drive P-Life Singapore property rental reversion this year is a doubt. So we think that with the CPI numbers being weak, P-Life Singapore properties could be growing at a slower rate compared to previous years. But that being said, their Japanese nursing homes remain in tight supply, and we remain positive on the Japanese portfolio. As for First REIT, we remain positive on the Indonesian healthcare reforms, and our strategy include ongoing healthcare reforms in Indonesia, which would drive First REIT's expansion plans in Indonesia. Secondly, we also advocate exploring REITs that are exposed to healthcare sectors where the macro picture is supportive. For instance, clients could look at REITs expanding their hospital networks in countries where there's a clear lack of hospital beds, such as in Indonesia or India. And for that, we think clients can explore looking at Religare Health Trust, but for now we don't have an official coverage on that. So next we move on to industrials. For outlook, we think that there is downward pressure on rents for factory space. This is because of pressure coming from the supply side, as there will be substantial completion of factory space of around 3 million square meters in 2015 and 16. Nonetheless, we think that demand for business park will remain healthy. Rental and occupancy will remain stable with potential for higher rents with lesser supply. As for warehouse supply, there's going to be about 1.2 million square meters of warehouse supply coming on, but out of all of that, about 75% is already pre-committed. Hence, we think that there is limited oversupply risk. Lastly, there is keen competition amongst landlords to secure qualifying tenants, and this could be made worse by supply pressure. Our strategy for the industrial space include to add exposure to REITs with business park spaces in the portfolio. Example of this would be Soilbook REIT, for which we have a buy call. Secondly, to be selective on warehouse REITs. Choose a portfolio of warehouses with good locations, such as near the ports or airports, or with superior designs. And superior designs for warehouses would mean those having modern ramp-up type features versus the olden cargo lift type of warehouses. For that, we think cash is a good industrial REIT to have in your portfolio, and we have an accumulate call on it. Lastly, we think clients can explore REITs that will have DPU growth through BTS projects in the pipeline. And BTS we mean built to suit. And for that, we think cash and Maple Industrial Trust are worth exploring. Next up, we have the retail sector report. So for retail, if you look at the occupancy rate for private and public sector retail space, if you look at the blue line here, you see that in the last quarter it actually dipped a little, and that was actually primarily caused by the dip in the occupancy rate for central region retail space. You see that for retail space in outside central region, they're actually basically pretty flat. And a look at retail sales, continuing from the trend last year, except for the bump in February due to the Chinese New Year effect, we see that retail sales this year has still remained sluggish. For outlook, we think that weak tourist numbers will negatively affect high street portfolio. For tourist numbers, we expect them to register higher year-on-year numbers towards the later part of this year. This is because of the low base effect created last year because of the huge dip in tourist numbers caused by the MAS events. STB's 20 million marketing campaign, which they introduced this year, and major sporting events in the later part of the year in Singapore, such as the SEA Games next week, or rather this week, and the WTA Tennis Championships. These events could provide some support as well. We do not, however, expect a huge increase in total yearly tourist numbers from last year because of a lack of significant tourist attraction openings this year, as well as the continual strengthening of the SGD versus the IDR. Because Indonesians are our biggest tourist group by nationality. As for our second biggest tourist group, the Chinese, they are actually faced with a lot more options now. A lot of other countries are trying to court Chinese tourists, such as Japan. They're actually relaxing their visa requirements for the Chinese tourists. And with the weakening Japanese yen, we think that at the moment, Japan actually presents a much more compelling option for Chinese tourists to visit. So for strategy, we advocate maintaining exposure on resilient heartland malls in Singapore, especially those with little upcoming competing supply, such as Fraser Centrepoint Trust. Secondly, Clients should capitalize on countries with growing middle class affluence and consumer spending power, such as China and Japan. For that, we have buy calls on Operations Retail Trust and accumulate call on Capital Land Retail China Trust. So our top ideas for the REIT sector, we have a buy call on Operations Retail Trust, buy call on Soy Built Business Space REIT, and accumulate calls for Capital Land Retail China Trust, First REIT, Cash Logistics, and Fraser Centrepoint Trust. Okay, next I'll pass on to Sam to touch on the Japanese network environment.
Good morning, everyone. Okay, so I'll walk you through this Japan report. It's more of a thematic report than the economic one. The bottom line is that we still maintain overweight on Japan. The Japanese equity has managed to break out 15 years high and has year to date earned around 16 to 17%. Consensus view on Japanese economy is that it is weak, but the thesis of this report is that the fundamentals really matter, and we believe not. Uh, so why are we overweight then? It's mainly due to the fund flowing into the equity market. Three main factors are the foreign investors, asset allocation shift by the world's biggest pension fund GPIF, and the BOJ ETF buying program. Before I move on to explain all these three factors, here is our recommendation in terms of unit trusts, ETFs, and the stocks that have investment or exposure in Japan. If you notice that almost all these unit trusts and ETFs are currency hedged, that is because our view is that the yen will further depreciate, and so we prefer to have hedged investment in terms of currency. Okay, so the first one, BOJ and pension funds, which we call this is structural demand. And so if you would notice that the BOJ has tripled their purchases of ETF to 3 trillion yen, which is almost around $25 billion annually. And then the GPIF has doubled their asset allocation from 12 to 25%. This is what we refer to as a structural demand. On the right top corner chart, you will see that the remaining allocation is almost less than 3% now when it comes to the pension funds. But the important thing here is that the next point which says that more Japanese pension funds are copying the asset allocation model of GPIF. Interesting thing is that around 3.7 trillion, there's a $3.7 trillion Japanese pension market, and assuming that the shift is around 10%, it makes it around 370 billion approximately dollars, and that is around 30 times the 1 year turnover rate of Nikkei 225, which is around $12.7 billion. Anecdotal evidence: three such smaller government funds, PMAC, PFA, and FADERZ, have already announced to imitate GPIF asset allocation, and we firmly believe that many more government pension funds will start to follow the same thing. Number two important factor in this fund flow, and one of the important one as well, is the foreign investors, which kind of share 60% of volume on the Tokyo Stock Exchange. That's huge. If I'm not wrong, they have around 30% of they bought around 30% of the entire market. And only last quarter they bought around 14.2 billion US dollars. These three are the major reasons, reasons why the equity market has continued to move on the green side. Okay. Domestic retail, we believe, is insignificant, although a lot of investors are talking about that the government is bringing on some reforms that might help them to invest their money into the equity market as well. We believe that it's highly unlikely. It's not easy to change the mindset of Japanese, which have been on the deflationary kind of mindset for the last 30 years. On the corporate reforms side, which is another important driver when it comes to the foreign investors, and the reforms such as improving corporate governance, lowering the corporate tax reform, in that much talk about TPP, trade pact is or would be the highlight for this year, and that is kind of giving confidence to investors as well. Equity valuation wise remains pretty much near to its long-term historical average of 19.2. And important thing is that it's driven by the earnings growth. The latest earnings season has continued to beat expectations, and we believe that corporate earnings will likely to be boosted by further economic stimulus plus the depreciating yen, which we think will further depreciate during the second half of the year. Which so two charts here. One on the right hand side is showing that the dividend per share has been on an increase since for last, I think, 6 years now. It will continue to increase. I mean, where the companies are paying dividends more than ever. I think, if I'm not wrong, last year was it increased, I think, 45% of that. And so, yeah, so these are the reasons why we are still maintaining our overweight on Japan when the economy itself is not doing well. With that, I will pass on to my colleague Ken. We'll talk about the technicals of some of these Singapore equities.
Okay, thanks, Sam. Hi, this is Ken here, the resident technical analyst. Just want to remind everyone that we actually have a weekly technical product that comes out every week. And this is just the report that we did 2 weeks ago on 19th of May when we started. So you can expect to see every week on Tuesday afternoon, essentially a weekly technical report which gives ideas on trading ideas. In this particular case, this one was about bullish signals. I highlighted potential bottoms in particular stocks on the Singapore Exchange and breakouts. So going forward, right, I'll try to highlight technical events that might occur, significant events that might occur in that week. Either they could be bottoms or tops or continuation patterns that look tradable. Okay, so I'm just showing you what we did last week. This is what the report looks like. You can find the reports under the Poems research portal, or for either Poems 1 or P2. Just go under research, go under Singapore, then go under strategy, and you'll see the technical reports. So for this particular one, 2 weeks ago, 19th of May, I highlighted these three stocks just for your info. The first one was a potential bullish reversal in Yuzu over here. And I would try to, I guess, justify it by clues that we see on the chart. I believe technical analysis is very much like detective work, where you try to look at a few things and see whether it comes together to form a thesis as to whether something is reversing. So in this particular case, I highlighted that we had a very recent trendline break, and this is a 1 yearly chart, right? a trendline break on high volume, okay, and the MACD has just crossed. So this heavily implied that there could be some intermediate term up move. Okay, so this is from 2 weeks ago. The price of Yuzu now is essentially 50% higher than 2 weeks ago. So so it was nice that that justified our recommendation over here. Following that, we highlighted a potential bullish reversal bottoming pattern for China sports. So here are the reasons why we have a potential double bottom over here, higher volume over here, and then there's a MACD divergence going on as well. So we would basically think that this potentially could also bottom out, but of course we should always put a stop at this price over here, at this maybe at the bottom of this double bottom. If the price drops down here, then it is a bearish continuation. If not, right, this is tradable, and the first target should be around here, this level over here. If you look at today, there should be another technical report coming out in which I actually highlighted these levels. Finally, this is the bullish continuation pattern where we say essentially MTech, right, which is an EMS company, is challenging its basically multi-year high on good volume. So essentially, right, we look to see that obviously a break of the all-time high puts into uncharted territories, and we don't know how much it could rise. But a break of the all-time high obviously implies further upside. So this is actually still in play. You'll see more. We'll give you an update on this this week. Okay, so expect this report over here to be every week. Okay, you can find it in the research portal. All right. So now I'll hand you over to John.
Testing. Anybody there? Okay, great. What was the last thing that you heard, please? Did you hear Kenneth? So did you hear the entirety of the technical presentation? Okay, great. So I'll just start again. It's John. I guess I was making some comments on the markets and the economy, so I'll just start that again. Okay, so yeah, here we go. Repeating from the top. If you're following U.S. data at all, if you look at that stuff regularly, you'll notice really quite a conflicting pattern in the way that the data is coming out. Friday data was really pretty negative. We saw a contraction in U.S. GDP of 0.7% for Q1. Just as an aside, the bright side of that might be that it could imply that interest rates won't be rising for a little bit longer than we thought. Also, consumer sentiment numbers were at 6-month lows. Chicago business activity was negative in May. There's been some speculation that we are in a technical recession, and the data in overnight in the United States on Monday didn't do anything to dispel that. We had ISM data, which were pretty positive, but on the other hand, flat consumer spending and some weak inflation data. So it's still a very confusing picture. If we look at markets themselves and see if they can guide us at all on what this all means, we find that bonds are strong, gold is strong, and the U.S. dollar is strong. And these are all often classic signals of market worries. Greece, there's been bank runs in Greece, and it looks perhaps like the Greek exit from the Eurozone might have taken a step closer to happening last week. So Europe, which has been a bright spot, may not be that much of a one any longer. The third leg of the stool is China. In China, there's been a concerted effort, of course, by the government to just pump as much cash into the economy as possible and stimulate. So far, the real benefits of that have been in asset prices. Obviously, stock prices are through the roof. Home prices themselves might have had looks like they might have had a good, well, not necessarily a good one, but a mild bounce in May, which is a bit of a relief. Nonetheless, what we want to see out of China is some fundamental growth, some real genuine recovery, or else it's all just smoke and mirrors, and all three legs of that economic stool are therefore on a bearish, sort of in a bearish mood, and that would possibly mean that we could be looking at a few down months in terms of stocks. In Asian stock markets, we have an interesting split. North Asian markets are up, Southeast Asian markets are down. India's not doing so great either. This would imply industrial and tech is a positive, but resources are a negative. So as far as Singapore goes, the play might be not so much the upstream plays, the resource plays, but midstream and downstream, namely industrials if you can find good ones, and consumer stocks, again, if you can find good ones. The REITs come to light as being particularly interesting in that regard, tying back to that. So in general, this is a time of caution. Things aren't going badly just yet, but there are rising bearish probabilities. So that's the view, or that's my view. I'll also note that the week, it's not such a terribly deep one in terms of economic numbers coming out, with one exception, which is that Friday we have the king of economic statistics, the U.S. job data. That's coming out on Friday. Also, Eurozone GDP data will come out on Friday. This evening in the U.S., we get some U.S. manufacturing orders, but So that may, in fact, be that may give us some insight into what to expect. The Bloomberg survey is showing that that's pointing to a decline, which would again suggest that maybe we are in recession in the States right now. Finally, as to the dividend calendar, there's none of note. Yeah, so that's it from me. Question: why is STI down 45 points? Well, as I'm waiting for that chart to come up so that I can talk to you about it, maybe it's because the U.S. is in recession. As I've said, the Singapore market is being dragged down by general Southeast Asian bearishness, which I attribute to heavy dependence on resources. But in addition to that, I hope you'll refer back to what I've just said and consider that maybe we're looking at a couple of bad months. Okay, well that is probably it from me. Just thanks for your. Yep.
Hi, Kenneth again. So let me just talk about the TA, right? So there's a question that went basically, if a stock is illiquid, can we still use TA? So the thing is, yes, if the stock is illiquid, right, in terms of just pure TA, it becomes difficult to apply because because of the liquidness of it all. However, why we still included that particular chart is because when we put in what seems to be bottoming patterns, right? the first thing to do isn't just to trade it straight away, because bottoming patterns can easily be broken. What you should be prompted to do is to basically decide, hey, you know what? Now's the time to look at this stock more closely. I should look at this stock fundamentally to see if the market has missed out anything. So when you see a bottoming pattern, especially a multi-year bottoming pattern, that should prompt us to look into the stock fundamentally to see whether the stock is really undervalued or that it's actually turning around. So the bottoming pattern is there to give you a timing window to decide that maybe the stock is turning around. Yeah. So even for illiquid stocks, you might not be able to trade it like directly in a sense, just intraday moves or whatever. But if it's a true bottom, right, then you can actually accumulate over time if it's a real bottom. So that's why we still include some illiquid stocks in there as well.
Hi guys, the Hong again. There's a question on First REIT, and the question is about the loan with CIMB that says that the Siloam Group must remain as the majority shareholder of the manager, and if these clauses are conflicted against, then it might trigger a prepayment event, forcing First REIT to pay back their loans immediately. So, if you have seen our initiation report on First REIT, how the structure goes is like First REIT is actually the parent of First REIT is actually Lipo Group. And Lipo Group, what they does is actually they will develop hospitals. And when the hospitals are stabilized, they will pass them on to First REIT to recycle the capital, as all developers need to, right? So first, Lipo Group, after passing on the hospitals to First REIT, they will lease back the hospitals and pay First REIT in Sing dollar terms. And then they will appoint Siloam Group, which they own 70%. So Lipo owns 70% of Siloam Group. So they will appoint Siloam Group to operate the hospitals for them, for First REIT. So how I see this is in the whole big picture, you actually have Lipo Group driving the whole expansion plan. So they are using First REIT as this capital recycling vehicle. So they list them on the local market, and they're using this REIT as a capital recycling tool, and using their subsidiary, the Siloam Group, which they own 70%, to operate the hospitals. So all three actually have this aligned interest in them, in that they are all in it together in this expansion plan in Indonesia. So I didn't really catch what was happening in that loan agreement, but in the sense all three will have their interests aligned, and it wouldn't make any sense for Lipo Group to do anything to derail the prospects of First REIT, because if you do that and First REIT is being forced to pay back loans, then your capital recycling tool basically is invalidated. So I don't think that would be a major concern for First REIT. And there is also a second question on Mapletree Greater China Trust. Officially, we do not have any coverage on that, but we can share something about what we took home from our results briefing, our latest quarter results briefing that we attended. So we had a note on that results briefing as well. So what I feel is that Mapletree Greater China, they have a shopping mall in Hong Kong and an office building in Beijing. The shopping mall in Hong Kong actually is doing very well, and they are achieving double-digit rental reversions. And that mall, like a lot of things are being said currently about retail scenes in Hong Kong, like after the big scene that the protesters did last year, Chinese tourists are not going to Hong Kong anymore. The retail sales is going down, and whether the malls there can survive. But for Mapletree Greater China Trust, their mall is actually very local dependent. They are not very dependent on tourist numbers. And I see them as a very proactive operator of the mall, in that they are very fast to catch trends. And that explains why they are able to replace tenants or pull in the strong tenants with fast growing retail tenant sales. And that is how they are able to achieve double-digit rental growth as well. So from that results briefing, I was actually pretty optimistic on this REIT, even though we do not have an official rating on it, or we have not done any in-depth valuation models on it. But just from a macro point of view, from what I hear from them, I feel pretty optimistic after the results. There's a question on when will the FOMC raise rates. Our house view is that the sorry, hold on.
Hi, Sam here. So there was a so, yeah. So there's a question. Do you think that FOMC will raise rates this month or in June? If they don't, then when will be when they will start to normalize? Well, the Feds will. Our view is that they won't start the lift off this month, or perhaps might go by September or December, because of the like what John mentioned, because of the not so strong economic data coming out from the US. So we still believe probably will be in September or probably December. December would be a better time to look for, but definitely not the end June. Okay, there's a question on should we hold back our investing activities till the normalization starts and then see the effect first? Well, when the normalization starts, it's a very the common thing that's gonna happen is what happened when they start the tapering, which will for a very short time period, like it will take the market off. But eventually, because our house view is still like to be on overweight, on long term, so if you're a long-term player, it doesn't really matter because the effect will be very short-term. It will be something like the tapering. When this first starting tapering, the markets were down, but then no one really cared about even when they ended the entire tapering thing, when they ended the entire QE program. So it's the same when they start to have when they first start to raise the interest rate. Probably you'll see a short-term uh, yeah, short, very very short term kind of downwards movement. But I think looking into the economy and the market itself, we are still very much bullish on the market, on the U.S. market. There's a question. Any cover on Noble stock all-time low? Unfortunately, the analyst covering Noble has left, and so we have the coverage on hold right now. But we would love to start coverage on it as soon as we have our new analyst coming in. There's a question, any view on CM Pacific? Well, we do not cover CM Pacific, or there's one more company asked about the QT Vascular. We don't cover these stocks yet. With that, we would like to end this webinar. Hope that you guys will join us next week. The next webinar will be as usual on Monday and not on Tuesday, just to make sure. And have a nice week ahead.